CNBC contributor. It's great to have you here. Thanks for coming in.
Great to see you, Scott.
You did call yesterday's CPI a quote-unquote game changer. Why?
I think it was the first time that the market could see an improvement in some of the underlying drivers of inflation, from shelter cooling to the durable goods cooling, medical, which was really on fire, flipping. And it means it's repeatable. You know, the Fed wants to see a series of lower inflation prints, and I think we're set up for the next few months of 0.2 to 0.3 month over month. That's 3.5% inflation.
You said the key thing, a series of lighter inflation prints. This is just one.
Correct.
It's just one.
But it does look really repeatable. Again, because medical insurance only adjusts every 12 months, it went from being roughly 2% a month to a -4. So you're going to get -4 the next 12 months. And shelter, which has been on fire as much as 0.8, is now down to 0.6, but now it's converging towards where markets are. So it's, I think it is very repeatable.
So let's get serious about this move. How far do you think it can go? How long do you think it can last?
I think that the June rally and the sort of false dawn pivot is a minimum template. That was about a 20% rally over 25 trading days. I think this one's going to be far stronger.
Wait. Stronger than 20%?
From the low. At least 25% from the 3,500. So something that could carry us to 44 or higher. And that's because we have, for the first time, sort of the ingredients for the Fed to do a convincing pause, to go from being a higher in a hurry to one that's more predictable, one that the markets can deal with, but possibly now raise the question that maybe the last hike is going to be December, and then the Fed's done.
Do you really believe that December is going to be the last hike for a while, that they do that and then they pause? Because their rhetoric, even in the face of the report you yourself call a game changer, was still pretty hawkish.
Yes. Powell's made it very clear. He looks at forward inflation, not realized. CPI is showing us what happened. If forward inflation is running at 3.5, a Fed at 4 3/4 is actually quite tight. And that, along with, we already see so many leading indicators of inflation being lower, that the Fed can move away from the hard data, see the job market cooling. Trucking is the most common job in 29 states. There's a lot of cuts in trucking coming. The labor market's softening up. I just think the case for accelerating inflation is over. You think, look, Jeremy Siegel, the Wharton School, was with me yesterday and said inflation's basically over. Yes.
It's kind of hard to declare that at a 7.7 print on the CPI.
Yes, the stock market in 82 bottomed when the inflation was around 7.5% on its way to 3. Volcker didn't posit pausing or ending the fight until October. So 10 weeks before the Fed actually even offered a view, the stock market had already bottomed.
You've been advocating FANG for the duration, for the most part, right?
Yeah.
Feels like those stocks are broken. No?
Yeah.
It really does. It's kind of undeniable that they look that way.
Yeah, it's been a terrible call. I think FANG still produces secular growth, but this year a lot of inflation companies, sensitives like energy and some industrials, produce growth that's much better. And you're right, they're crowded. I think you're right. I think the market's going to question FANG for some time, but I think they should still be in people's portfolios because they're high return on equity companies. They solve inflation in the future, but that's not what people care about today.
Well, I'm thinking of, if the Fed, what do you think the Fed's going to do in December, by the way? Because, it all plays into the same conversation about these mega cap stocks and other areas of tech.
I think the futures market has it right. They're looking at 50 basis points, and unless we start to get so much cooler inflation, I would say the odds are that it's either 50 or 25, not 50 or 75.
Carl Icahn was with me yesterday, and he, he's been negative on the market. He's hedged. His hedge is expressed through a short on the S&P 500, in large part because it has such a high tech weighting. And he thinks tech is still overvalued. Can you make the case that it's not?
Yes, I can. In both 1940 to 57 and in 1970 all the way through 87, the way the economy solved inflation was an acceleration of tech spend and a parabolic growth in revenues. I think that's what investors are forgetting. They're thinking tech is a high multiple sector. they're literally the solution to wage inflation. And so demand, once we come out of this inflation cycle, is for tech products to go up.
So you don't buy into the belief that value is going to outperform growth for a substantial period of time?
I think value as a factor does, which is really balance sheet intensive companies, because you're going to make money off your balance sheet. If you have cash, you make money. If you own inventory or resources, that goes up. A lot of tech companies are asset intensive or balance sheet intensive. I mean, cloud companies like Amazon are actually balance sheet stories. So I think tech can work in a value regime.
But do you think value outperforms?
Yes, yeah, because if the 10-year, let's say the 10-year hovers here between 3.5% and 5.5%. Which, by the way, since 1871 is the highest PE for the market. The market average is almost a 20 PE. Investors will buy companies that have visible earnings, which is value intensive. So they should outperform.
Crypto and the NASDAQ have been pretty heavily correlated. If crypto continues to come down, doesn't that weigh more heavily on the NASDAQ?
Yeah, it looks like the linkage might be breaking. Michael pointed out with NVIDIA and Bitcoin. I mean, crypto is caught up in a really dark period. I mean, there is a systemic event that happened this past week. It's triggered enormous losses, and I mean, devastating losses for a lot of folks I know. That means crypto is going to be tough to own. It's really only for the brave. But I think it is going to come back.
That was that one saying, fortune favors the brave. I mean, maybe it was fortune favors the naive, who thought that this was this new and incredible, long-lasting asset class, even in what was a highly speculative market for an asset class that was entirely unregulated.
Yeah, Scott. Crypto has a lot of folks who are trying to create change. It's attracted a lot of greed and money, and unfortunately, just like other early stage, 90% of all projects will go to zero. But that's the history of capitalism. Since 1970, of the 40,000 stocks issued on the stock exchanges, more than half fell 90%, and of those, half went to zero. So capitalism is about this creative destruction, but it's been super fast cycles in crypto, and it's been devastating.
I mean, there are people who, let's be honest, Tom. I mean, there are people who put some of the more high-profile evangelists, if you want to call them, on the wall of those who hyped this asset up. They may very well put you on that wall, right? There were times where you talked about 100,000. There were times your firm had very lofty targets. How do you feel and think about that today, and the kind of responsibility that you think you and some of these others may bear, and just the hype?
Yeah. Well, Scott, nobody wants to make a call being optimistic about something and seeing it go down. It's a terrible feeling. We've been really trying to keep our clients close to what we're seeing, and Sean Farrell does a great job, and I think your teams update his views. It's an ugly period. It's going to be tough for anyone who is straying outside of Bitcoin, which is what we like. But, we don't want people to lose money. Bitcoin is going to cause losses this year, but it is cyclical. And so, we're optimistic that Bitcoin's blockchain works. It actually is cheaper to move money. It is pretty useful, but it's not going to turn around before the end of the year. I think it might take some time.
Why is it cyclical? Why isn't it simply just a moment in time asset in an environment that was free money for everybody for a long period of time, and that's the only reason we saw it do what it did? And now it's going to come back to earth. It's going to be a much different asset. It's going to be more highly regulated. People are going to be a little more studious in the way that they sort of look at it as a viable asset class moving forward.
Yeah, that's a fair point. Crypto is quite tribal. You might know that there are people who are Bitcoin maximalists and others. The Bitcoin community has strayed away from leverage, trust and verify, and that part of the crypto has actually worked. It did benefit the rest of it from free money, but Bitcoin itself is a reflexive asset. It's really how many people own wallets, and today it is still cheaper to move money, and it's more secure. In the entire Bitcoin blockchain, since inception, close to $20 trillion of money moved, zero fraudulent transactions.
Did you guys have any money caught up in the FTX stratosphere?
FundStrat has not done any business with FTX. We have no financial relationship. We've never done business with them. They were a really well-respected company. We would have loved to have done business with them, but
maybe not today. You would.
Yeah, so I think it's been a blessing. You know, we're a research firm, so we do advisory. They're a much more trading-oriented firm, so we just never had overlap, and we never did business.
Let's bring in some others and expand our conversation if we could. Hightower, Stephanie Link with us, Greg Branch of Veritas Financial Group. Both are CNBC contributors. So, Greg, let's begin with where we began, Tom and me, on this notion of, do you agree with his assessment that yesterday was a game changer for this rally?
I absolutely do not. There's a couple of things that I disagree with. Number one, I think that it would be naive to say that December will be the last hike. I think the Fed has laid out that the terminal rate, if it's not 5%, it's certainly very close to it. And I don't think that they raise a whole percentage point in December. In terms of the range, I think the range for December is probably 50 to 75. A lot's dependent on that CPI number we see in December. Lots of people have been extrapolating for the better course of a year now that this will be a linear retrenchment. And it's been anything but that. In April, we saw that the monthly went from 1.3 to 1 and then back up to 1.3 in June. And so I doubt that this is also linear. With respect to Tom, there certainly are some things in this inflation report that we can hope was permanent retrenchment, such as maybe the housing element. I doubt that. Such as maybe used auto pricing, probably. But there are other elements that will probably have a spike again into the holiday season, like airfares. And so my bet would be that we see something more than the 7.7% for November that we saw in October, particularly when you bring the base effect into account. Remember last year, we saw a jump from 5.4 to 6.2% from September to October, but then that moderated from October to November, only 40 basis points from 6.4 to 6.8. And so it was likely, even if inflation on its own was not retrenching, that just due to the base effect, we were going to see that headline number come in. Mm-hmm. And now that it's not going to come in as much next month, I think that that'll work the opposite. I bet we see an 8 again for November.
You want to respond, Tom?
Sure. I mean, just something I'd point out, you know, we often look for cross-market for validation or confirmation. Yesterday was the largest drop in 2-year yields and 10-year yields almost in 10 years. It was the second largest. It was March 2020 was the larger one. And then you have to go back to March 2009 to find another large move. So this CPI report was really respected by the bond market. It's been seen across the curve. So I think they're treating it, the bond market's treating this as not a fluke, but a real change.
Steph, a real change? Is that what this is?
Well, it's progress. How's that? I think that the CPI report had something for the bulls and something for the bears. So on the positive side, the headline number, the core number being down relative to expectations, very good. Owner's equivalent rent coming down, very good. And that was a surprise. And it actually also coincides with the prices paid PMI indexes, which are a 6-month leading indicator for the CPI and PPI. So those numbers have been collapsing. And so that's all good. It's all, you know, that's the positive. The negative is that if you look through the numbers, services, which is 73% of core CPI, is actually still very elevated, right, at almost 5%. So that means that most of the decline from the expectations was goods oriented. And we know that. We know goods are collapsing. Just look at the order rates and the cancellation rates. So we might be getting closer, Scott, to the Fed getting done. I don't think it's this year. I think we have at least 50 or 75 more to go, but we also don't know what the implications are. We've talked about this. We don't know what the impact is going to be on the economy. We know it's going to slow. Does it slow in a soft landing? Does it slow in a recession? And so that's still the unknown. So I think the rally has legs into the end of the year. We've talked about this. Seasonality, it's your friend, right? Sentiment, very negative, and positioning. So I think you can rally into the end of the year. What we do after that is really going to depend on the economic data that we get. And by the way, I would just say one thing. I think the real positive, at least for corporate earnings, is the dollar, how much it's come back. And if we have a little bit less inflation and a weaker dollar, that's very good for earnings, for much better than what we were fearing.
So why, Greg, is seasonality, off of Steph's point, not your friend? I mean, you still think that we have not seen the lows of the year? With 6 weeks to go, momentum maybe on our side.
I'm going to stick with that view, Scott, but I'm sticking with it with the least conviction that you have experienced in our one-year relationship at this point. Never before, and look, Tom and I have been making the polar opposite call for the better part of the year now. Never before have I had as meaningful a doubt that this might be right. There's a couple of things that could go wrong with my view. Like you said, seasonality, the Santa Claus rally is a real thing. Typically, the 3 months from November to January, we see about 4.5% performance. Any other normal 3-month period, the average is around 2.9. So the Santa Claus rally is real. I will be wrong if we see something 7.5% or less for November. If we see that, the market will have 2 pivots to concentrate on. Not only the fact that, yeah, inflation retrenchment will be a straight line retrenchment, and that we will see month-over-month decline, and it won't be volatile, as the Fed said. But secondly, I think that would be reason for the Fed then to think about coming off the gas a little bit, for the market to contemplate a terminal rate that's less than 5%. And then lastly, the pace of negative revisions. And remember, that's been one of my big boogeymen, is the negative revisions, and that estimates were wildly off where they needed to be. We entered the third quarter that way with an expectation of about 10% earnings growth. We entered the fourth quarter much closer to the reality, I think, that we'll experience, where right now the estimates are for negative 2% earnings growth. If in December, when we get that print, the estimates are at 1%, flat, 2%, then we won't have the headwind of needing significant negative revisions. And when you combine that with the Fed backing off the gas, with a victory declaration in terms of inflation, then yeah, that could be a sustained rally. My bet is that not all those things happen.
Okay, Steph, so you added this week to Caterpillar, to Estee Lauder, and to Meta. Why?
Yeah. Yeah, well, I mean, look, Wednesday was really ugly. As great as yesterday was, Wednesday was really ugly, and some of these stocks got hit really very hard. And so to me, I think with Estee Lauder, I like the fundamentals, I like the products, but it's really the catalyst was China potentially reopening kind of thing, and also the stock being down so much. They have 30% of their revenues in China. So to the extent you believe China does reopen, even if it's partial, that will help. They already lowered guidance. On Caterpillar, they only have 10% in China, but I do like their diversified revenue mix, and I think the energy component is so misunderstood because you have had massive underinvestment for years on end, so they should benefit. And then on Meta, I like the fact that he's cutting costs even more than I thought, right? I thought that you were going to see 10% in terms of layoffs. Now you're getting 13%. Maybe he has religion, maybe he doesn't. But anyway, you look at it, this stock trades at 5 times EBITDA, and they do have a core franchise that is very strong, and actually the Reels piece is actually showing improvement, so that's encouraging.
All right. Tom, I gave you the first word. I'm going to give you the last. Leave us with a thought we can think about in the, for the next week at minimum. We'll get some economic data. You got a lot of Fed speakers.
Yep.
You got another CPI in a month, and then the Fed meeting.
Well, I think that the big picture, if I took a step back, is inflation's been really tough to defeat most of this year. We haven't had any signs that the services, as Steph was talking about, was cooling. We're finally getting that break. BLS breaks that line out. X shelter and core is 0.18. We're at 2% services X housing. That is giving the Fed some breathing room. The job market's cooling. The Fed is no longer the enemy of the market as much. And I think that allows us to make a pretty big rally, especially given how many people are off sides. Most of our clients are bearish. So, they've been had their head wrong, but they're still bearish.
I appreciate you being here. You always show up. You always answer the questions in good times and struggling times, and I appreciate that. And I know our viewers do as well. That's Tom Lee from Fundstrat. Steph, Greg, thanks.